Hello, everyone, and welcome to another episode of Thoughtful Investing. Today, we'll cover energy transfer with a particular focus on income investors. I'll start off with a brief overview of the company, explain why this company is poised for growth, compare it with the competition. Then, we'll take a brief look at the financials with a focus on distribution, i.e., dividend safety. And then, we'll perform a valuation, and I'll share with you my view of the company. And then we'll wrap up with a quick bonus section on K1 tax forms, which is something you have to know about if you want to invest in these sorts of companies. So with that, let's get started. Energy Transfer is one of the largest and most diversified midstream companies in the US. They operate about 130,000 miles of pipeline infrastructure across 44 states. Let's take a deeper look. This visual does a great job of explaining how energy transfer plays in the energy space. They're involved in crude oil, natural gas, and natural gas liquids gathering and transportation. On the crude oil side, they're involved with gathering the crude oil from the wellhead and transporting it to the storage terminal. From there, it goes to the transmission lines and on to refining. On the natural gas side, they support the link between the wellhead and the processing and treatment facilities where the raw natural gas is purified and all the moisture, sulfur, and other impurities are removed. From that treatment facility, part of the natural gas goes into natural gas liquids, and then the rest goes to transmission line storage and on to the end user. Similarly, on the natural gas liquid side, it undergoes a process of fractionation, which is a fancy word for separation, where the natural gas liquids are separated into individual streams of propane, butane, ethane, etc. And these streams have huge petrochemical applications. Overall, if you combine all three of them, crude oil, natural gas, and natural gas liquids, you'll see that the end users include industrial, residential, petrochemical, transportation, power. Overall, if you look at the stats on the right, you can see that they're capable of gathering about 20 million BTU per day of gas and then transporting another 32.4 million BTUs per day of gas, coupled with the ability to fractionate about 1.1 million barrels per day of natural gas liquids and transport 6.7 million barrels per day of crude oil, which is about 7% of global consumption. Finally, in terms of export infrastructure, they're capable of exporting about 1.85 million barrels per day of crude oil and 1.1 million barrels per day of natural gas liquid. So this gives you a pretty good idea of their footprint across gathering, transmission, and even export of petrochemicals. Here's another visual which gives a pretty good idea of the distribution of this company's assets across the US. Now let's take a look at the individual business segments. As you can see on the screen, both revenue and EBITDA, which is a fancy word for earnings before any interest, tax, or depreciation is applied, is pretty well distributed across the four segments of this business, which are natural gas liquids and refined products, midstream, interstate transportation, and crude oil. Now let's take a quick look at every one of them. On the natural gas liquids and refined product side, they're involved in the transportation, fractionation, and export of natural gas liquids, and then the refined product pipelines that they have. They have a huge hub in Mont Belvieu, Texas. On the midstream side, they're involved in natural gas gathering and processing with a strong presence in Permian Basin. They recently completed an acquisition of WTG West Texas Gas midstream at a cost of about $3 billion. So this is a business segment that continues to expand. On the interstate transportation side, which is pipelines that go from one state to another, they have long-term contracted cash flows, which means that their cash flows are not as volatile as the price of the underlying commodity. And then crude oil, they're involved in both the transportation and storage terminals with exposure to all the leading basins of production, which is Permian and Bakken, along with the export capabilities that we just talked about. Now, if you take a look at the geographic footprint, you can see that they're present across all the major producing basins, Permian, Haynesville, Bakken, Eagle Ford, as well as the hub of refining and petrochemical production in the US, which is the Gulf Coast. So it's clear that they're pretty well diversified and play in several value chains. Now let's take a look at the growth levers for this company. The first of which is AI, which, as we all know, needs data centers to function, and those data centers have a huge power appetite. In fact, it is projected that by 2030, 9% of total US electricity consumption is going to come from data centers. Just in Texas alone, 150 data center projects are right now under consideration. And so as those data centers get built and electricity demand goes up with it, Energy Transfer and other companies providing natural gas power are poised to benefit. The second is the regulatory tailwinds. Just with the passage of the big, beautiful bill by the Trump administration, we saw three things. Firstly, permitting for pipeline projects have been streamlined and fast-tracked. Secondly, environmental requirements have been reduced. And thirdly, the judicial review process has been optimized such that there will be far fewer litigation and far shorter litigation, which means that all the growth projects that these companies are working on, including Energy Transfer, are going to come to fruition a lot earlier. And finally, the LNG boom in the US is going to be a major benefit to natural gas pipeline companies because that will be an outlet for their exports. In fact, the US is now the largest exporter of natural gas in the entire world, surpassing even Qatar in 2023. So if you look at all the growth projects that they have planned, there is about $5 billion of capex just in 2025. And as you will see in that list, there are other projects that are coming to fruition in 2026 and even beyond. So there is a steady pipeline of these projects, which are going to be permitted fast now with the new tax bill. And so all that growth is going to be fast-tracked. And so earnings should continue to grow up at a steady clip. Now, if you compare Energy Transfer with the other pipeline companies, there are 5 big names that we have to consider. The first is Enterprise Product Partners, which has a strong fee-based model, but is focused mostly in the Permian. So less geographical diversity, but they have a great distribution record, better even than Energy Transfer. Kinder Morgan is another one, but they are focused only on natural gas and doesn't have the same diversification as Energy Transfer. One Oak is more concentrated on natural gas liquids, and they have a smaller network with smaller regional focus companies. And then Williams is also concentrated geographically in the Northeast. And then finally, Enbridge, which has majority of their assets in Canada and so have limited U.S. reach. So if you compare Energy Transfer with the competition, you will not find the same product and geographical diversification anywhere else. Now let's take a look at the financials. If you look at the revenue and free cash flow, they have consistently gone up except during COVID and in 2021, where we had a major disruption in the energy market that impacted pretty much every player in the energy industry. Revenue is up about 5% year on year for the past 10 years. Earnings per share have grown even faster at 12.8%. And then free cash flow, which is basically the amount of money left over after you've invested your capex, has grown at about 18%. Overall, the stock has yielded a benefit of about 8.5% over the past 10 years once you include the distributions. So pretty steady stock performance, except for that brief period during COVID. Now, if you look at the liquidity analysis, which basically tells you how much of their current liabilities can be covered with inventory and CAB, respectively, with the current ratio and the quick ratio, they have both gone up, which basically means that they have grown more and more financially stable over time. Similarly, the debt to EBITDA ratio has gone down, which means that they are taking on less debt relative to their earnings. Similarly, the interest coverage has gone up, which means that it's much easier for them to afford the interest on the debt that they have taken. So overall, from a financial health standpoint, the debt to EBITDA numbers look good and are improving further. The debt service is also good because of good interest coverage now. And then the credit rating right now is BB+, but there is a path towards improving it further to the next level, which is BBB-. There's only one other pipeline company that has a better credit rating, and that's Enterprise Product Partners. If you look at their distribution, i.e. dividend record, you can see that they have a record of increasing it, except during that time during COVID, where they had to pretty much cut it in half, and it took them a couple of years to recover back to the pre-2020 levels. And from there on, they have continued to grow it. And the projection is that the growth will accelerate in the coming years because of all the growth projects that they have in the pipeline. Similarly, the distribution coverage ratio, which basically tells you how much distribution they can afford to give out to their stockholders or unit holders, as they're called, that has also improved quite a bit. And it's basically above 1, which means that they can easily afford the distribution that they're giving out at this point. Now, if I was to take a look at their core record for distribution, you'll see that 2015 to 2019 was the growth period. 2020, you had a distribution cut, and then 2021, it recovered. And from that point on, it's continued to go up. So the future looks good based on the growth projects that they have in the pipeline, the supportive regulatory framework, and the growth levers in place. Now, let's take a look at the valuation. On the valuation side, if I set the discount rate to about 10%, which is right in line with the long-term returns expected of the stock market, The growth rate to about 7% for the next 10 years, which should be achievable given the growth projects that they have in the pipeline, and a terminal growth rate after that to 3%, which is roughly in line with GDP. That gives us a fair value of about 16.5, while the stock is trading near $18 right now at a dividend yield of 7.3%. And so personally, in my opinion, this stock may be attractive for income investors, but below 15.5, at which point the dividend yield would be 8.5%, which is pretty good. Now, if you are an absolute stickler for distribution safety, then you may want to consider another pipeline company called Enterprise, which comes with a lower dividend yield, but they have a better track record than Energy Transfer of distribution safety. They did not cut during COVID and did not even cut during the great financial crisis. So you have a trade-off then between Energy Transfer, which brings with it better diversity on the product side and geographical side and stronger growth prospects, and a higher dividend, but with a less than perfect distribution record versus Enterprise, where it may not have the same diversity in product or geography, but the distribution has never been cut, although it is lower than Energy Transfer. So ultimately, that is a decision that every investor has to make for their own selves. Now, I did promise to you that I will have a special bonus section on K1 forms, so let's get to it. A lot of these pipeline companies like Energy Transfer are structured as MLPs, which stands for Master Limited Partnerships, which basically means that the entity is not taxed at a corporate level, but at the level of individual partner, as in the unit holder or the stockholders for this company. And so instead of issuing a standard 1099 that other companies do for their dividends, they issue a K1 tax form, which arrives a little bit later, March or April. And so you may have to wait a little bit before you can file the tax. And because these companies operate in multiple states, it may require filings in more than one state. In addition, it is not recommended to keep the units or stocks of these companies, these MLPs, in any sort of independent retirement account like your 401k or your Roth accounts. They're better suited for general brokerage accounts because of something called the UBTI, which is a little too complicated to explain here, but just know that it's not something that you keep in your retirement account, but in your general brokerage account. But then the benefit is that the distributions or dividends that you get are often tax deferred because of how they are structured. And so in many occasions, you will only pay the tax when you actually sell the unit or the stock. So all in all, it's a little bit more paperwork, but has more tax benefits and could be a good fit for long-term income investors as opposed to somebody who is just trying to trade in and out of the stock. This brings us to the end. If you liked the video, please hit subscribe. And if there's any other company that you would like me to review, please let me know in the comment section. I'll see you in the next video. Thank you.